Hi, I'm Grant Mundell, investment specialist at Equity Trustees with our January market update. If you thought you were going to get a relaxed summer holiday month, you were sorely mistaken. January was notable for geopolitical volatility, including the US's capture of the Venezuelan president, increased US tensions with NATO allies over President Trump's desire for Greenland, and civil unrest in Iran. Other market moving points included continued and magnified commodity price rises, the expectation of a near-term RBA rate hike, which at the time of recording has just occurred, and a continued fall in the US dollar, which saw the Aussie dollar rally over 4%. By and large, however, investors look through the geopolitical volatility. Equities mostly rallied, with the ASX 200 jumping 1.8%, US S&P 500 up 1.5%, and global equities up around 1.6% in local currency terms. Emerging market equities jumped 8.8%, with Asia ex-Japan up around 8.6%. Given the jump in the Aussie dollar, however, in Aussie dollar terms or an unhedged basis, global equities fell 2.75% for Aussie investors. Within the ASX 200, sector divergence was apparent, with energy up 10.6% and material, which includes the resources sector, up 9.5%, helped by soaring commodity prices. Precious metals such as gold and silver, base metals such as copper and nickel, oil, uranium, lithium, all rose strongly. Fundamental and technical factors, investor positioning, and the US dollar all impacted. High commodity prices have fed through to higher earnings for the resources sector, which in turn has increased the earnings outlook for the ASX 200. 2026 is forecast to be the first year of earnings growth in the ASX 200 since 2022. The IT sector, conversely, fell 9.4%. IT stocks have suffered from valuation concerns, interest rate concerns, and software stocks in particular have fallen on fears of competitive displacement from artificial intelligence. IT and other growth stocks have derated considerably, presenting some new interesting investment opportunities in previously expensive stocks. Otherwise, bond yields mostly rose around the globe. Locally, the macro data remains hawkish. Economic data has been broadly strong. Labour market tightening, strong household spending, and elevated business conditions were all key features over the month. Credit growth remains strong and house prices rose again in January. Most notably, inflation remains too high and persistent, with Q4 trim mean inflation running at 0.9% quarter on quarter or 3.9% annualised. Capacity constraints and productivity concerns are issues the local economy needs to solve for. This will be challenging in the near term for some domestic-facing industrial stocks as investors price in a more challenging environment ahead. So how are we seeing things? Well, 2026 looks set for global economic growth to remain broadly resilient, supporting equity market earnings growth. Despite higher than average equity market valuations, strong earnings growth should provide for moderate gains. Our expectation is that global economic growth will remain reasonable at about 2.8% in 2026, just under trend. Australian GDP growth improves to around 2.3%, but momentum starts to wane as rate hikes weigh on sentiment. Earnings per share forecast for the year ahead is around 13% for global equities and 11% for Australian equities, which is nice and strong and resilient. Equity market valuations, however, are mildly expensive, and that could really cap the gains. Real assets such as property, securities and infrastructure appear fair value. Australian fixed interest is looking more interesting, with 10-year bond yields at around 4.75%. And the outlook for income has improved, most notably for tax-exempt income-seeking investors. The ASX 200 underlying dividends are forecast to grow for the first time in 3 years. While seeking your own independent advice, in the current market, we recommend being invested in well-diversified portfolios to capture upside risk in each asset class while protecting any downside risk. We have a slight preference for global equities over Aussie equities, given the stronger growth outlook, and think that select defensive and real assets offer solid risk-adjusted returns. I'll be back next month with the February market return.